Is investing in Germany via a letterbox company in a tax haven a good idea?
Especially for investors from the US. It used to be very common to invest in European companies via a company in a country with a zero or low tax regime, such as Ireland, Isle of Man, BVI, Jersey, Guernsey, Malta, etc. The idea was to hide the beneficial owner and to profit from zero or low taxes when extracting profits from the operating unit in Europe. Now, in times of money laundering and transparency rules, the beneficial owners practically cannot hide anymore. Tax advantages are still possible, but the tax authorities have abolished many of them with BEPS and Co. Since this is not known to the majority of investors, vital mistakes are often made. Here are some recommendations.
What is still possible and what is an absolute no-go?
A holding company in a tax haven may be beneficial, but certain rules must be respected. First, substance. A foreign company without substance is disregarded by the German tax authorities. That is, they will look through the company. Dividends paid to the company will be treated as paid to its shareholders. Substance requirements depend on the kind of business the company is doing and the rules of the jurisdiction you are looking at. If you look at the conditions of the German law and the interpretation of the German tax authorities, the company must be a permanent business participant in their home country, active in its ordinary course of business, participate in the local market permanently and sustainably, employ local management and other staff. However, the international approach, also followed by the European Court of Justice, follows a different approach, where the company should play an active role in the economic life of the country of residence. For this, it is normally sufficient if the company has its own staff, a fixed office and office equipment. It has just been ruled by the European Court of Justice that a Cypriot pure holding company fulfills the substance requirements if it resides in the office of another company and uses the staff of another company. Its only own staff member was the managing director, who took over administrative tasks. Therefore, it could be sufficient for holding companies in the future to just employ a managing director in the country of residence who will perform administrative tasks and use other staff, the office and office equipment from another company. If your company in the tax haven fulfills the substance requirements, you may still profit from the parent subsidiary directive or the low taxation in the tax haven. However, it must be said that pure letterbox or shell companies are an absolute no-go nowadays, as they will never be accepted as a corporation for tax purposes by the German tax authorities. Secondly, we can speak about adequate transfer prices. Before you do so, you should understand that transfer prices don't play a role if your company has no substance. If a company does not exist tax-wise, no tax-relevant business can be done with it. So substance is first. If you want to extract profits from a European operating company to a company in a tax haven, you also need to make sure that the operating company receives an adequate return for the payments. Example: if the operating company is charged for services, there should be adequate staff performing the work in the tax haven, or the tax haven company must pay another company adequately for performing the services.